Hey everyone, this is Dimitri Pragmatic with MarketChameleon.com. In this video, I'm going to demonstrate how to analyze a call option to determine is it a candidate for an early exercise. And we're going to use Pepsi in this example. And the setup here is the following. Tomorrow, on August 31st, Pepsi is going ex-dividend, and the dividend is $1.26.5. And we went to the August 30th options chain, and we want to determine before the X date, should we exercise our call? The reason behind it is the following. If you own shares, you're entitled to the dividend. The company pays a dividend to its shareholders. The company does not pay a dividend to option holders. The option holders are not entitled to that dividend, and you have to determine, do I want to exercise my call and convert it to stock before the X date so I am entitled to that dividend? And to do that, let's come down here to the options chain and analyze a particular option to see, is this an early exercise candidate? Now, you don't want to exercise an option that is out of the money, because then you're going to end up buying the stock at a higher price than where the market is currently, right? So that would not make sense. You want to look at an option that you own that is deep in the money. Okay, so let's take a look at maybe this 150 strike. Okay, so the 150 strike is deep in the money and it's expected to move 1-for-1 with the stock price. Basically, if the stock goes up $1, it's expected, the option is expected to go up $1. If the stock moves down $1, it's expected to move down $1. So it has the same risk profile as the stock. And you don't want to exercise an option that has time premium left. That's another test you want to do. Now, to do that test, what we're going to do is take the 150 strike and add it to the bid of the call, which is $30.80. So if we add the two, that adds up to $180.80. And we want to compare that to the stock price, because if that is above the stock price, then we don't want to exercise it. We're better off selling the call because there's time premium left. And when we compare it to the stock price over here, that the stock is $181.70. So we don't want to sell the 150 call at $30.80 because that's below parity, right? That would be selling it below parity with the stock. In other words, you're better off exercising the call, selling the stock, but you don't want to sell the option below parity. So it passes that test. The next thing you may want to look at is, what do I give up by exercising this call? And can I replace what I give up? So one of the things you give up is that when you exercise the call, you're no longer limited to your loss at the 150 strike. Once I exercise the call, I own the stock, and the stock could go to zero. So I'm no longer limited limited in my loss to that 150 strike. So what does it cost me to protect myself at the 150 strike? Well, I could look at the put, and the put is offered at a penny. In other words, yes, I convert my call to stock, and I could lose on the stock if it goes below 150. However, if I buy the put for a penny, if it goes below 150, then this put will start to offset my loss because the put will start going into the money. So it'll cost me a penny to protect myself on the 150 strike. And is that worth it? Well, let's come back up to here. If we exercise the call and we receive that 126.5 dividend, even if we take a penny out of that dividend to pay for the put, we're still ahead $1.25.5. So in this situation, it appears that this option is a candidate for an early exercise, because by exercising that call, we'll be able to get the dividend before the X date, and we could still use some of those proceeds to buy our protection, buy that put, and still come out ahead. So hopefully, everyone, this was helpful, and hope to see you guys in the next video. Thanks.